Good morning, everyone. We're just going to give a couple more minutes, see if there's a few more people joining us this morning, and then we will make a start. Okay, I think there's a few more people joined us, so we will make a start. Welcome everyone to this morning's session. My name is Louise, and I will be hosting for you. Just to start, a couple of housekeeping matters. If you are unable to hear anything on your computer, you are able to log in via telephone. The details are on the slide. I will apologise in advance. We have had a couple of technology issues already this morning, and I do not vouch to be any sort of technology expert. So if you have got any issues, please just drop something into the chat and we will try and get that sorted for you. Chat function also available if you do have any questions. We have got quite a lot to go through, but I'm hoping there will be time at the end. If there isn't, we will get back to you via email. You can also contact me after the webinar. Again, my details are on the screen. And the session is being recorded and it will be circulated along with the slides following the webinar. So don't feel like you need to take any excessive notes. So from an introduction point of view, many of you will know me. I'm Louise. I'm one of the partners here at Mitchell Charlesworth, specialising in the not-for-profit, but also housing associations and corporate entities. I am joined by a fantastic team of fellow partners, managers, and accounts and audit staff as part of that charity team, and we have a full spectrum of services. So we will do, in most cases, the compliance, audit, independent examination, quite a bit of advisory, bookkeeping, and we also do our payroll services. This is the first of a webinar series with a lot of changes coming in this year. So you can see there we also have next week corporate entities, 15th of April housing associations, and there will be another one for those of you that work with in the academy sector. So just to set the scene, I think it's quite clear that the Charities SORP 26, which is coming into play for periods starting the 1st of January 2026, is one of the most significant updates that we've seen in a number of years. And it is to align predominantly with best practices and the international standards for financial reporting, but it also looks to improve clarity, accountability and proportionality for charities. And the Charities SORP working group have done a really fantastic job of bringing this SORP to life and giving some really practical and real life examples to assist the users of the SORP in making sure that they are interpreting and implementing this correctly. This shift reflects the growing demands really from the regulators, donors, beneficiaries for more transparent and meaningful reporting that isn't just looking at the financial statements, but also how the Trustees report brings to life how that charity is creating value for society. Sorry, we seem to have jumped a few slides there. It is bringing in a 3-tier reporting regime, and we will look at that in a bit more detail, and also more enhanced narrative around particularly governance, impact reporting, ESG, really to create a lot more of a story behind what the finances are looking at like. So we touched upon the 3-tier reporting structure, and this is really to make sure that there isn't an overburden for smaller charities, but larger charities are given more clarity and more disclosure around what they are doing. So we've got tier 1 for small charities. This covers charities with income up to 500,000, and this offers more simplified narrative and accounting options. Tier 2, which is for medium charities, and this includes charities with income between 500,000 and 15 million. And this is bringing in some new impact reporting requirements, as well as reporting on reserves and risk, as has always been the case. It is important to note that Tier 2 charities will need to adopt both the requirements for Tier 1 and Tier 2. And then we've got the Tier 3, which is large charities. So this is income over £15 million. And this requires the fullest level of disclosure, including the mandatory ESG reporting. And really, it's reflective of the public and regulatory expectation that these larger organisations will demonstrate leadership in sustainability, governance, and longer-term planning. And this tier system helps the charities focus reporting on really what matters and avoids imposing a one-size-fits-all model across the sector. Just giving a little diagram here of what the key aspects in relation to this new reporting structure looks like. So you'll see here from an income threshold, as we've already touched upon, the impact reporting, and we will look at this in a little bit more detail. For Tier 1, it is literally describing the basic impact. Tier 2 is a little bit more detail around explanations of the outcomes in respect of that impact and the actions that are being taken. And then in Tier 3, this is where we're going to start looking at evaluating the longer term social impact overarching the charity's objects. From an ESG reporting point of view, it is optional for Tier 1 and Tier 2. And when we say optional, we really mean encouraged. But we will anticipate that given some of the detail behind this, it may not be very practical, particularly for the Tier 1 charities. And of course, for Tier 3, that is mandatory. Looking at the narrative requirements, so when we're talking about narrative, we are talking about trustees report, accounting policies, anything that brings the accounts to life. So for Tier 1, we are looking at a simplified approach to narrative requirements. For Tier 2, expanded, and then for Tier 3, fully comprehensive. And what will be quite a good thing for a lot of charities in that Tier 2 is that a cash flow statement is now only required for Tier 3 charities. So looking then at the narrative reporting, and obviously a lot of this will focus on trustees board reports. And I think what we are seeing is that there has been quite a significant overhaul and differing requirements for the tiers. So it's really important that you understand which tier you're falling into in plenty of time so that you can start thinking about these additional requirements. Trustees are still required to prepare a thorough report, which is no surprise, which is balanced, fair and forward-looking. And those for you who I've presented at board meetings, etc., I always say that the board report should tell the story of what has happened during the year, celebrate the successes, put some context behind things that may not have gone too well, and really give the reader of those financial statements the context behind where the numbers have landed. Aims, objects, activities and public benefit all remain as they were. And the great thing about this SOP, as I've already mentioned, is that the SOP does provide some really good examples and prompt questions which will help in preparation of the content. What we are seeing now is with the significant enhancement, we have got some new items bringing in. So one of the core changes is that there is a heightened emphasis on impact reporting, which is now mandatory for all charities. However, as we've already seen, it is stepped up the higher the tier. We are also seeing more detail required around financial sustainability and reserves. So here it's taking what the reserves policy is and providing more detail as to why key decisions have been made. It's also going to cover in more detail financial resilience, future plans, and risk management strategies. One of the things we'll look at in this session is those changes to going concern and future plans. ESG reporting, so for those of you who fall within tier 3, this is really important in respect of the environmental, social and governance metrics. They do include climate and workforce, but there is also social and governance metrics as well that fall within there, as well as cybersecurity, board diversity, community engagement. And these changes reflect a broader expectation for ethical conduct and transparency. So really understanding these narrative requirements is essential to producing reports that not only meet the compliance standards, but also strengthen stakeholder trust, those users of the financial statements, and communicate the value proposition of the charity more effectively. And then, of course, we've got trustee engagement and training, which, brings in the collaboration between the finance teams to understand all of this reporting and the ESG requirements to ensure both compliance, but also that the charity is really communicating in the best way possible with those external stakeholders. I know there's a lot of questions being asked about impact reporting, as it is one of the bigger changes, and it's also relevant to all tiers. And really this is to enhance transparency. It is to create clearer communication of the charity's mission, the charity's strategy, and impact across all of the stakeholders, all of the public, to boost that transparency. So what does it actually mean? So we are looking at creating a clear narrative that details what change has been created as a result of the charity's operations, evidence of that impact, who has benefited and how have they benefited, what are the long-term outcomes, and both the positive and negative effects must be addressed. We have given some examples here just to put that into practice. So reporting reduction in homelessness rates, obviously supported by what the charity have done to achieve that. What are the long-term educational outcomes of youth programs, if that's one of the charitable activities. Measurable environmental benefits from conservation programs. So you can see here, it's really taking what the charity is doing and maybe taking for granted, but really celebrating it and giving the opportunity to put some context behind what has been done, and most importantly, what has been achieved. So along with the SORP 26 changes, we are also seeing some changes being brought in later this year. So these changes will take effect from the 30th of September. And again, this is to further reduce the administrative burden, particularly for the smaller charities. So the income threshold for requiring an independent examination will rise. So it's currently £25,000. It will increase to £40,000. So that will mean more charities will be exempt from external review. For those requiring an independent examination, the threshold for a professionally qualified examiner increases from 250,000 to 500,000, again allowing a bit more flexibility in appointing examiners. Audit requirements will apply to charities with income over 1.5 million or assets exceeding 5 million. Of course, currently that is 1 million and 3.26 million respectively. These adjustments aim to make compliance more proportionate. Of course, if you take a charity audit with £1 million of income, that is quite significantly different to what a company is turning over to reach that audit threshold. So it is bridging the gap, albeit there will still be quite a bit of discrepancy between the two. but it also maintains that robust oversight for the larger entities. So really, it's just understanding where you sit within those thresholds and whether voluntary audits or examinations are appropriate for additional assurance, and seeing where you fit for those changes, so that you can plan nice and early. So we now get into some of the more significant changes from a finance point of view. So the first one we'll cover is income recognition changes. And this has been derived from aligning more closely with international financial reporting standards. And of course, FRS 102 released their changes some time ago now. Charities SORP followed suit by adopting a very similar approach. But of course, as we all know, the diversity of income in charities does mean that there isn't an easy fix and an easy way to sometimes recognise that income. So what the SORP has done is it's really taken the existing SORP, looked at FRS 102 and really practically applied that so that you can see how it would work in practice. So the main changes are in relation to exchange income recognition. So this is where we have contracts or fee for service arrangements, and they must be recognised using a 5-step model. And we will look at that more closely to really understand what that means. Non-exchange income, so donations, fundraising, etc., grants. So these will remain on a detailed performance model guidance, still considering conditions and restrictions, so not so much of a change in respect of those. From a legacy income point of view, there are clearer rules outlined in the new SORP, specifically in relation to disclosure. So not so much of a change on when you would recognise those legacies. And I know this is a really big issue, particularly with the levels of accrued income that arise from legacies, obviously with that earlier recognition to when the cash is physically received. So it is more around the disclosure of what has been recorded but not yet received. And I think everyone will agree this is probably a welcome change to really give some good oversight as to what the numbers mean when actually the cash hasn't been received. And I think one of the main things that has arisen from these adaptations to the SORP is the need for improved documentation and really robust internal processes to be able to review contracts, manage those contracts, and make sure that the income recognition is being identified and recorded in the correct period. So what do we mean from the 5-step model? I've given a bit of a diagram here, but I think the best way to go through this is to look at a practical example. But some context, the 5-step revenue model does require the identification of the contract, reviewing the obligations that are in place, looking at the pricing and what the perceived transaction price is, allocating that transaction price to the performance obligations in the contract. So really, really crucial is actually understanding those performance obligations and how they are going to be met, and then recognizing revenue as the entity satisfies those obligations. So if we look at a practical example, so here you'll see we've got a contract for service provision. So contract to deliver a 3-year mentoring programme with a £450,000 grant. Conditions are that the charity must deliver mentoring to 600 people within this time frame. Annual reports must be submitted. There is a clawback provision for any targets not met. And in this case, we are going to apply the 5-step model. So if we break that example down into those 5 steps, you'll see here step 1. So step 1 is identifying the contract with the grant provider, looking at the agreement, looking at the enforceable rights or repayment conditions, looking at the obligations that are set. In this case, obviously, we've got a number of mentoring posts that have to be delivered for that income, and the performance conditions. Once we fully understand what the contract is saying, we can then move to step 2. Step 2 is identifying the performance obligations. What is it being paid to deliver? What are the combined services? Is there one service? Is there a number of services? And how do they interact with that transaction price? Are they dependent on the funder? Are they interdependent activities? Can you measure the outcomes separately? Or is there only one performance obligation? So in this case, there is just one performance obligation, and that is deliver mentoring to 600 people. We'll then move to step 3. So this is the determining of the transaction price. So we've already aware that in this case, it's £450,000. But actually, what you would need to do is consider the variables. Consider, is there potential for underperformance, because that might lead to a clawback? Is the payment only made once you have delivered those outcomes? Therefore, we need to consider the estimated expected value or the most likely amount. Moving on then to step 4, we'll then allocate the transaction price to the performance obligation. So if we are now fully aware that actually 600 was overly ambitious, but we are on target to deliver 500 mentoring programs, the transaction price would be adapted to reflect that reduction, and it would reduce to £375,000 in this case. So then we'd move to the final step, step 5, and we would recognise income as those performance obligations were satisfied. So in year 1, if we delivered 200 mentoring programs, we'd receive £150,000. In fact, I'll rephrase that. It's not about the receipt. It is about the recognition of the income. So in year 1, we'd recognise £150,000. In year 2, again, delivered 200, we'd recognise another £150,000. And then in year 3, where we have fallen short of what we were anticipating to deliver, we'd recognise the £75,000. So you'll see here, it's important to really understand the contract and then be able to reliably estimate what is going to be delivered on that contract to then recognise the income. Of course, if the receipt was front-loaded and upfront, you would then defer anything that wasn't in relation to the income you could recognise in that period. So moving on to the next most significant change that we've seen coming out of the revised SORP, and that is in relation to lease accounting. And I think this is going to be the area that probably impacts the majority of charities, and some of it can be quite significant amounts. So this is now reflecting greater transparency in financial reporting, but really bringing it in line with international reporting standards. So operating leases must be recognised on the balance sheet as right of use assets with a corresponding lease liability under these revised standards. Of course, historically, operating leases were treated simply as rental expenses recognised on a straight line basis. However, they will now be recognised on the balance sheet. This really ensures that the economic reality of the lease obligation is reflected in the financial statements. Once you have recognised that right of use asset, it will be depreciated over the lease time, whilst any interest on the lease is front loaded. So we are going to see some changes in the expenditure side of things that is recognised in each year. And of course, the income and expenditure point of view, that rental expense will be replaced by the depreciation and interest. Now, we are getting a number of queries around the discount interest rate that would be applied. And I think this is going to be one of the main sort of estimates and judgments in respect of these changes. But essentially, it's the interest rate a lessee would pay to borrow funds necessary to obtain the asset if they were buying it up front of a similar value to the right of use asset over a similar term and with similar security. So it's going to need some thought to establish what the discount rate would be. And if you do need any support with that, then we would be more than happy to help establish what leases there are, but also understand the impact of bringing these onto the balance sheet. There are some exemptions. So we have exemptions for short-term leases, so if they're under 12 months, and also low value assets. Now, the SORP doesn't define low value assets. It doesn't quantify what low value assets means, but it does give some examples. So it will mention photocopier leases, mobile phone contracts. Those are the sort of small. It doesn't go up to cars. Unfortunately, cars will be brought in or any vehicles. So what you'll need to do is really understand what leases you have, understand those lease terms, and understand how this will impact by bringing those right of use assets onto the balance sheet. And of course, there is going to be an impact on reporting and some of the key metrics that and KPIs that a lot of charities use. As balance sheet values grow, costs become front-loaded, and also fund allocations within the SOFA may change. So here's a practical example. We've got a property. Property rent is £50,000 per year, and there is 5 years remaining on the contract. So under the old SORP, we'd be recognising £50,000 per year on a straight line basis. However, under the new SORP, we'll be identifying the present value of the remaining lease payments. So essentially 250,000 undiscounted. We would then need to appropriately apply a discount rate. So either the lease rate, so if there's an interest rate implicit in the lease, or at the incremental borrowing rate, which, as we've just mentioned, is usually how much you would be paying for a similar amount of money on a similar period of time. The lease is then initially measured by creating the asset for, it would be the discounted amount. In this case, we haven't applied a discount, but you would debit the asset, the £250,000, and you'd have a corresponding lease liability created. This would also include any initial direct costs, any prepaid lease payments, and we would need to take into account any lease incentives received. Depreciation is then applied over the remaining lease term. So again, in this case, simplistic, £50,000 per annum. And the lease liability is increased by the interest expense and decreased by the lease payments. So you'll see that over that period, the lease interest on the discounted amount will be higher in the first year and then fall off as that amount reduces. So of course, the impact on the financial statements is that it is going to affect the balance sheet. It is going to impact the SOFA presentation, which will also in turn affect key financial ratios, particularly on the front-loaded expenses, but in relation to the fact that you will have right-of-use assets that are in fixed assets, and your net current assets are going to reduce by the corresponding lease liability. So really, really important that you are all thinking now of what leases you do have and what are the terms of those leases, and really understanding the impact on the financial statements from the first year of implementation. Thought it'd just be useful to highlight here the impact on donated and peppercorn leases. Because obviously a lot of charities will get donations or opportunities to lease land, buildings, or even in some cases plant machinery for a reduced amount. So if you are paying a peppercorn rent, then you would recognise the lease liability and right of use asset based on the lease payments. And in this case, it's going to be a tiny amount. Now, there was talk of actually bringing it in at a fair value amount. That isn't the case. It is just based on the peppercorn. And you may take a view here on the basis of materiality as to whether they do come into the balance sheet. And from an income side, you would recognise the donated facility element equal to the difference between the market rent and the peppercorn rent. So this would just be in line with section 6 of the Charities SORP, and that is donations in kind, essentially, where you'd recognise the income and a corresponding expense. So nil impact from a SOFA point of view. If you are granting a peppercorn rent to another entity, then you would recognise the peppercorn rent as income, and you'd recognise charitable expenditure equal to the market rental value if it's for charitable purposes. And then free use of, if the property is donated, again, you would just recognise the donation in kind at fair value and the matching expense, again, in line with Charities SORP section 6. Looking then at the transition adjustment, so there is going to be a lot of work before the first year of transition. So if you're thinking now, the changes to the SORP did come in from the 1st of January 2026. So if you are looking at when your first year of reporting under the new Charities SORP is, it will be December 26 year end or thereafter. So thinking about it now, you will need to consider the impact, particularly of those income changes in this 5-step model, but also on the leases. And gathering that information now will put you in a really good position to transition quite easily into the new reporting requirements. The FRC have provided some transition guidance, but they expect entities to apply the new rules predominantly using a modified retrospective approach. So this essentially means that you don't restate all of the comparative periods, but you recognise the impact as an opening balance adjustment at the start of the year of adoption. So if you think about, go back quite a few years now, when the new FRS 102 came into place for UK GAAP, there was a transition period and there was a lot of notes at the back of the accounts which essentially bridged the gap from how you were previously accounting to how you are now accounting. And it's exactly the same in this case. You will be required to provide enhanced disclosures explaining the transitional impact in the financial statements in the first year, but there is no need to restate all of the comparative periods. So from an income point of view, so this will mainly be around the 5-step model, and when you are considering any exchange contracts that the charity may have, then you do have a choice of retrospective or the modified retrospective, as we've touched upon. And I'm guessing a lot of people are going to go for that modified retrospective where not restating all the comparatives, but the differences will go through the fund accounts and reserves. For leases, there is no option. You are expected to recognise right of use assets and liabilities at the transition date rather than recalculating prior year P&Ls. And there's no restatement of the comparatives required. However, you will need to understand, of course, what leases are making up at that point in time. So you will need to have that full listing and really understand what you are bringing onto the balance sheet at that point in time. So looking at some of the other changes that we are seeing, fund accounting, no significant changes other than they are now requiring a greater explanation of the different funds and how they are defined. So if you are a charity with a number of different funds, endowment funds, specific designated funds, a number of restricted funds, you will be required to disclose a little bit more detail. There is also a new requirement that fund disclosures must include any legal powers used to remove any of the capital restrictions, or if you are amending the purposes of a restricted fund or allowing an endowment fund to convert to income, you will need to disclose how that decision has been reached and what legal powers have been used to reach that decision. From an accounting standards, policies, concepts and principles point of view, again, there's nothing significant changing, but there are some things to note. So from a going concern point of view, you must confirm that you've considered information about the future and significant judgments. So if you recall, in your accounting policies, you will quite often have the going concern note. Now, that was voluntary unless there was a material uncertainty. It is now required, which takes us back to pre-2016 when we had to do that anyway. And obviously, if there are no material uncertainties, that note is now a must. It's not voluntary. Of course, if there are material uncertainties, then full disclosure is required anyway. From a materiality point of view, accounting policies should be tailored to only disclose material items or transactions. So what they're trying to get away from is this boilerplate, here's a list of every accounting policy you could ever need, just in case we have it. It's actually looking at a bit more tailoring, a bit more precision in really just understanding those accounting policies that relate to significant items or transactions within the financial statements. In assessing that material, the materiality as to whether an accounting policy is disclosed, it isn't just looking at the numbers, but it's also looking at the users of the financial statements and an expectation of what they would want to see. And then on accounting estimates, there is a requirement for additional information in relation to estimates involving the use of judgments and assumptions. And this again aligns the FRS 102 requirements. Few other changes, again, not overly significant, but worth mentioning. Donated goods and services applies in full to all tiers, and it does bring in some minor clarifications and improvements, more specifically around donated goods for resale. So those of you who have any charity shops, particularly would be interested in just getting an update on here in respect of when you would potentially recognise a value against them. Of course, at the moment, it's very hard to put a value on that, and therefore you wouldn't, but it does give some examples as to when you would put a value on it. Provisions, contingent liabilities and contingent assets, and funding commitments. So there is actually a new module, so module 10A, which essentially brings the guidance across all of the various SORP areas into one place. So that really does help give some clarity over exactly what's required rather than having to find it embedded in other areas of the SORP. And it does provide some really good guidance on funding commitments and when you would disclose those, onerous contracts and other contingent items with some really good practical examples. From a post-balance sheet events point of view, again, no change from post-balance sheet events point of view, but what it does do is give some more relevant examples as to what is an adjusting or a non-adjusting event. So worth a read of that section just to fully understand what post-balance sheet events should be brought into the financial statements. Okay. So looking then at those changes, you'll have seen quite a lot of change around narrative reporting, enhancing those board reports, which I know do take a lot of time and a lot of thought process behind. And I think, as I said, telling that story it is the easy part. It's bringing in those practical examples of the impact reporting, of the ESG reporting that are going to probably take a bit more thought and time. And certainly on the ESG reporting for those tier 3 charities, you may be thinking internally about how you're recording data, what you're doing to be able to do that reporting, or potentially even bringing in third parties to support that journey. Likewise, the impact reporting, social impact is quite hard to quantify sometimes. And I know I've had a lot of discussions with my clients around, you know, how do you actually get a true feel for the outreach and for the, you know, the community engagement. So this again is going to need some thought as to how you will be able to not just report what you are doing, but those outcomes arising. So this, and you'll be pleased to know we are nearly on the final slide, but this slide is really just to bring it all together and understand what you should be doing now to prepare for these changes coming in. So evaluating charity income levels to determine where you are in those tiers is obviously a no-brainer. Reviewing the governance and reporting, so identifying any gaps in the current narrative reporting and then focusing on those new requirements depending on what tier you're in. Obviously, the more detail, the better, but I also appreciate that it is quite onerous on boards and senior managers to be able to produce, you know, these reports. So looking at the guidance, giving some practical examples is really important. Engaging stakeholders and training. So obviously, first step is, you know, you're here today, you're going through this and making you and your teams aware of what the changes are and how they are going to impact. And, you know, that is going to differ from charity to charity. There's no doubt about that. Updating policies and systems. So looking at internal policies, particularly on the risk, particularly on reserves and that impact measurement, but also looking at whether there is need for investments in systems for the ESG reporting, or as I've mentioned, if you are going to look at third parties, and also ensuring that the accounting software is SORP ready. And then the final point on here, and I think this is going to be sort of the more digging into the detail and really understanding different income streams, is looking at the income contracts, looking at the impact of the new accounting standards, looking at that 5-step model and really understanding, is there going to be a difference in the way you are recording income as a result of those sort of steps? And then, of course, gathering that lease information, understanding which leases charity has in place, determining which are going to be deemed low value and which are going to fall within the right of use asset regime, and then identifying what rate of interest you will use in bringing those onto the balance sheet in the first year. So I'm going to see if there are any questions. And we've got a question saying, does this apply to service contracts or also grant funded projects? Now, I assume that is in relation to the changes in the income and the 5-step model. It will be service contracts, but also grant funded projects if there are performance measurements as well as outcomes. So this is the real reason you really need to understand each of the separate contracts that are in place where you are delivering a program or delivering any level of service performance to tie into that grant or service contract. Thank you. Any other questions? There's nothing come through. As I said, if you do have any questions, please feel free to contact your usual engagement partner. Feel free to contact me or any of the team, and we would be more than happy to help. Thank you very much, everyone.